Greetings, Professor McKee here with our next Seminar Saturdays video. And this week we have a paper about real estate, Realtor Lender Networks. The paper is called Referral Lending and Mortgage Market Power, the Role of Realtors by Panle Jia Barwick, Han, John Kroah, and Dayin Zhang. My apologies if I mangled anyone's name there. This was presented at WFA back in 2025. And it's a bit of a short paper, so this will be a fairly short video compared to some of the other ones this semester, but it is very well focused on the research questions, which is nice as someone reading the paper and trying to understand what's going on. It's a lot easier to explain when it's very tightly focused. So I thought I'd highlight that. All right, so we're going to talk about realtor referrals. So if you've worked with a realtor, they generally have a lot of contacts in the local real estate market, which this is one reason you would hire an agent. They have expertise that you don't have. So they can help you, if you're the buyer or seller, find good people, good companies to work with, to do all the things you need to do when you're making a home purchase. There is a dark side, a downside to this, which is also why hiring agents can be bad for people, which is they might refer clients to people that they are friends with and receive kickbacks, either formally or informally, because they're friends with the people that they're sending you to. Basically, there's an agency conflict potentially between the realtor and the client. They're a real estate agent, and real estate agents are classically one of the great examples of potential agency conflicts. So what this paper is going to look at is referrals to lenders. And if this is a detrimental referral, we're probably going to see it come into play through higher interest rates, which is a pretty objective way to measure that there's been an agency conflict problem here. It's a lot harder to really see that, oh yeah, you paid too much for your home inspection, or the home inspector didn't do a good job. Those are hard to tell, but your interest rate on your mortgage, that is something we can actually see. So a lot of times our papers, we focus on things we can actually see, because otherwise there isn't much for us to talk about, even though there are other ways you could have agency conflicts. So the data they have, which is very new data for me because I've not done much in real estate in terms of my own research, and not been talked about much either. So they have MLS data for the mortgages and the associated buyer agent. So they know who the realtor was and they know what the information on the mortgage was. They link that to HDMA mortgage data. So they have more data about mortgages. And then they have Fannie Mae, Freddie Mae, and Ginnie Mae, which are all quasi-government agencies involved with mortgages for the loan performance. So what happened with the mortgage after you buy the house. They can't observe directly the realtor network, their social connections, their connections with those loan officers, but they can see how often buyers who work with the realtor go to the same loan officer. So they use some measures of concentration. One of them I'm familiar with, the HHI. The other one, the CR4, which they use, I'm not familiar with. But apparently 0.7 is considered high and 0.4 is considered medium concentration. And so if it's highly concentrated, in other words, most buyers who work with this realtor go to the same loan officer, they take that as evidence that there's a realtor network here with that loan officer. And this is what the concentration things look like. So under CR4, there's 28% of these realtors have a high concentration where they're directing a lot of people to the same lender. There's a big chunk, probably about something like 10. I'm not quite sure what the density would be because this is not like the exact percentage, but there's a big chunk here that are directing everyone to the exact same loan officer. And there's HHI index, which has not exactly the same concentration measure, but there's clearly some that are much more concentrated and direct all of their clients to a small group of lenders. Meanwhile, some are like maybe don't do it at all. So they have an empirical prediction, which is, let's say we have agency conflicts here that is harming the realtors. It's probably going to harm the people that are heavily using the referral networks. And it could be explicit kickbacks, could be something more subtle. But we would expect to see higher mortgage rates for people that are working with the realtors that have high concentration. So they're looking at people within the high quintiles. So the highest quintile versus lower quintiles. And the interest rate spread off the prime rate, which is just a comparison with the prevailing market rate. And yeah, if you have a high quintile, your interest rate is higher. If you are in a low quintile for concentration, your interest rate is also higher, but not by very much. It is much smaller in economic magnitude. Of course, this is just correlations. We might not have causality here. It might be that people who are going to get, or who are going to have to get higher rates are going to these highly connected realtors. Maybe there's something about those highly connected realtors that attracts the clients who aren't going to get a good interest rate. And I can think of a number of stories where this might happen. So they are going to try to come up with an experimental design setting in order to deal with this. There's a lot of ways a clever reviewer can come up with stories. Perhaps the loan officer and bank is very dominant, and so buyers are naturally using it, and it's not actually a referral. Maybe the causality is reversed. The buyers had a connection to the loan officer who sends them to their favorite realtor. That would show up as a correlation here too. So what they do is an instrumental variable approach. This is one that is quite common. I've seen it in a number of papers, and I've reviewed a number of papers so far that have been doing this. And what they use is a prediction of what lenders the borrowers choose, but they don't do it for the initial purchase. They look at refinancing. They believe that refinancing is not driven very much by referrals from realtors. That kind of makes a lot of sense. If you're refinancing, you've already made the purchase, you already have a mortgage, you're not going out and making a purchase or sale. You're just going to the bank, whatever financial lender you're talking about, and getting a new loan. Why would you even work with a realtor? There might be some residual effect of like, well, you were recommended to this loan officer 3 years ago by your realtor, and you like the loan officer, so you stick with it. But you're not being recommended again through the same network. And so the logic is that when we use the model to predict refinancing, they have some sort of model that does this, the second stage regression can then strip out the lender choice decision for the mortgage. And we are only getting what's left, which is the referral part. It was a little bit difficult to follow exactly what they're doing here, and I am not a super expert in econometrics, but it makes sense to me that the refinancing part wouldn't really be connected with the referrals, because this is completely different from a purchase where you would have a real estate agent. You don't have a real estate agent when you're shopping around to refinance your mortgage. So running this instrumental variable, what they find is that you had high concentration and your interest rate spread goes up. And an interesting thing here I'd like to note, because of all these fixed effects they're using, so they have a year, month, county, lender fixed effect. So you went and got a loan, same month of the same year, you're in the same county, you're at the same bank or lender, whoever's lending it to you, you have a different loan officer. So this is capturing the difference between loan officers at the same company. So it's not even that it's just a realtor sending you to one favorite bank. They're sending you to one favorite loan officer. And these kind of really deep fixed effects is quite helpful because there's a lot of stories that you might come up with that this fixed effect just sort of rules out. Like, well, it's not a time, there's nothing going on with time here because we're comparing people that are within the same month when they get their loan. So there's no time trend that changes your interest rate or whatever. So I thought that's quite helpful for them that they were able to have all these fixed effects and things work great for them. So that is something I wanted to point out. They do look at some subsamples, some heterogeneity as they call it, where they're looking at types of people who might be more strongly affected. So they do find that borrowers that have worse debt to income, so that's what DTI means. You have more debt versus your income, so you're kind of a worse credit risk. That tends to mean a higher interest rate, and interacting with having a referral, your interest rate is even worse. Your loan to value, so again, the higher the loan is relative to the value of the thing you're buying, also makes you more higher credit risk for this loan. Again, that interaction, so you have high loan to value and you're getting referred, that results in a higher spread off the regular rate. Being young doesn't seem to hurt you. There's no effect if you're under age 35 when you're buying a house, probably your first time home buyer, and a relatively young one because this is right at age 35 is when kind of the average age nowadays. At least that's what I think. At least I think that. I probably shouldn't say that too confidently. And they also find some interactions with on the basis of race too. So you get worse deals if you're um, Black or Hispanic. So interacted with referral, your rates go higher. It's reverse for Asian for some reason. So there's some minority group implications here for the referral networks. Now, this is perhaps convincing that we have a high interest rate, but that's not the only thing that people care about with a loan. Um, I'm not quite sure if some of the fixed costs, like the closing costs, are included in the interest rate. I suspect that they are not. But other things like the speed or actually being able to get the loan at all, because maybe if you're a really high credit risk, you're not going to get this loan unless you get the referral. Possible, right? So there might be things that you're trading off the interest rate on in order to get your loan faster, or you paid more but you close faster, or you're more likely to be approved. And those are generally good things for the borrower too. So you might not want to maximize just interest rate. Okay, so they can look at how fast things close. And it turns out that there is a benefit here. The days that it takes until the purchase closes, it's lower if you had a referral. And you're less likely to take longer than 30 days for it to have your loan, your transaction close. There's no effect on something going greater than 45 days. I am not really sure why they picked 30 and 45, although perhaps those are standard lengths of time in the industry, which in that case would be a perfectly normal reason to pick it. But there is a benefit in speed. It's not a huge benefit, but it does seem like because of the referral, you're getting this loan done faster. And there are delays, like there can be all sorts of things that delay getting that loan approved, and closing faster is a kind of a good thing. I mean, I've seen a number of advertisements of banks, financial companies saying, hey, we promise we'll be able to close in a certain number of days, and if we don't do it, we'll give you money back or something. So clearly consumers do actually care about this. They also look at risk, and it doesn't seem to really do much. So the borrowers with good credit are, even the ones with great credit, their scores above 780, they have great loan debt to income, they have great loan to value, they're still getting big increases in their interest rate spread. So these people have great credit scores, they are going to get approved. They don't need they don't need any potential referral network to ensure they get approved. It's going to happen. Someone will want to lend to them. They're good. They're a good credit risk, but they're still paying more. Them so it can't be coming really. This is at least some evidence that it's not coming from I need this referral in order to get the loan, because there's people who definitely don't need help to get the loan and they're still getting these higher rates. That is a logic that the authors are pushing in. And keep in mind, this is very, again, they're using the same fixed effects, the same month within the same county. They are comparing things here, right? And that is everything for this paper. Again, as I said, it's a very tight focus paper that's all about those mortgage rates and some potential trade-offs. Given that there is some benefit, but in terms of loans closing faster, but it's probably not a net benefit for most borrowers. It's not a very high increase in speed of closing, and it's a pretty substantial increase in interest rates. So it's likely that this is a poor trade-off for most of the borrowers, and it's therefore coming from reduced competition, agency conflicts that are pushing the business to someone who's going to give them a worse deal. All right, and that is everything for this week's paper. Hope you enjoyed looking at real estate market. If you did, please comment, like, and/or subscribe so that others can find these videos too. And I will see you all next week.